We're in Nairobi and talking about the Central Bank's Monetary Policy Committee meeting, which just happened, and the statement came out in the last hour or so. It's titled Consolidating Monetary Policy Gains to Support Economic Activity, and the shock decision to bring down the rate by 150 basis points. Most analysts, 8 out of 12 forecast by Reuters, expected 100 basis points cut, maybe 50. And this 150 has been very much surprising to most people. Einstein Kihanda is with us. He's Chief Investment Officer at ICEA. Many thanks for coming on the program. Were you surprised by this?
Yes, I was surprised about the extent.
Yes.
My own expectation was about a 50 basis cut, a notional cut of 50 basis points.
Right.
But I think, yes, the 150 basis point for me was actually...
Is it justified? Because they're talking about consolidating monetary policy gains to support economic activity. Do you think they've explained themselves well enough to justify this?
I think they have. One of the things that one notes in the monetary policy statement is the fact that there's an acknowledgement that inflation has been on a decline. The currency has also stabilized, as well as the fact that the budget also factors in an element of offshore borrowing, so it will also reduce a bit of the pressure on the exchange rate. And I think it's an acknowledgement that any further delays in terms of not having a rate cut would actually have an impact on economic growth. Particularly if you look at the statistics on the growth of the economy released for the first quarter this week, there's actually an indication that growth was down by about 3% from 5% last year. And the key sectors like the finance sector, construction were all affected, a reflection of the fact that high interest rates were a big factor in that decline. So I think it's an acknowledgement that...
because it appears that number, the GDP number of 3.5%, might have played a much bigger impact on this than maybe if we didn't have that data, we might have been talking about something completely different.
I think that is, you're quite right about that, but I think therefore, I mean, the committee therefore has to factor in the developments in the economy in order to make the right decision. So I think that is a very key factor, because on the one hand there's a balancing act in terms of trying to manage the currency, but also the fact that you don't want to stifle growth in the economy.
Is the shilling stable enough? Because there's still some volatility, maybe not major, but there's concerns from the Eurozone and how that might affect us.
Yes, I think on the short term it is stable. We've got the proceeds from the syndicated loans. We've also received indications from the IMF that they'll also be releasing some tranches of funds. So in the short term, it is stable. But I think, and that's also something that the Monetary Policy Committee has acknowledged, is that we still have a high current account deficit, yes. And the structure of our economy hasn't changed in terms of a very heavy weighting of imports vis-a-vis exports. So I think on the long term, we need to really address the issue of how we can be able to build our export markets to be able to address the vulnerability of the shilling.
One of the things the statement says towards the end is that the committee also decided to revert to its bi-monthly meetings. The understanding is that therefore to keep a closer lead on things.
Yes, the fact that they had a monthly meetings actually started towards the end of the year,
right,
last year, at the height of the inflation and currency crisis,
yes. And
there therefore was a need to have monthly meetings in order to closely monitor the developments. And I think the fact that they are now going to have bi-monthly meetings is also an indication that they are more or less confident about the current situation, and they can be able to give a longer lead time for the effects of these measures to be felt. Effect. Yes.
But what would be the likely immediate impact of this rate cut?
I think we're likely to see that the immediate impact will be maybe on the bond market, in the markets. We've actually seen the turnover in the markets being a bit, the market has been underperforming, and I think it's because the market has not been, was waiting to see the direction in which interest rates would move. And also in the long term, ultimately, also on the banking sector, that we're ultimately likely to see a reduction in the rate. So I think the direction is what the market was really looking for.
For most consumers really would like that last part you mentioned about the lower interest rates. The statement from the MPC says the open market operations have stabilized the interbank rate, though there are concerns. We were speaking earlier with Ken, who says the open market operations might have distorted the fixed income side of things. Yes,
I think we've actually seen in the last say month or so, we've actually seen, particularly short term on the market, we've actually seen rates decline significantly.
Yes.
And one of the views has been that the rates had gone down too fast, and we actually started seeing a rise in the last several weeks. So I think you're right that there's been that distortion in the market, and I think the direction that the Monetary Policy Committee has given would more or less stabilize the rates in the market.
They're hoping also with this that inflation will keep remaining low. It's 10.05% is where we were last time, but they appear confident that it will hit their target of about 9% in the next few months. Do you share that view?
Yes, I think if you look at the key factors, one is food. Food prices have actually, we've had fairly good, strong rains, and therefore food prices have been on a decline. The other element has been the oil prices.
Yes.
We've actually seen on the global markets, oil prices have stabilized, and these are a very key component of the import requirements. So as long as oil prices are on a decline, I think we're likely to see that the inflation rate will also stabilize, as well as the fact that the impact of the tightening of monetary policy in terms of credit growth had also had an impact. So I think we are likely to see a consistent decline in inflation.
Do you feel the confidence in the economy is as strong as they indicate? One of the reasons they're saying is because the NSE is on an upward trend, and the private sector has shown that they expect inflation to continue declining, and basically the economy remains strong.
Yes, I think, although of course it's worth noting what I mentioned about the first quarter growth, that the economy had actually slowed down.
Sure.
But I mean, we're an agricultural economy, and at the times when the agriculture sector is doing well, we actually see that translating into overall GDP growth. So we've had strong rain this year,
yes,
and therefore food supply has been fairly strong. So I would say on the whole, there's some level of confidence in terms of the economy and the sustainability of that going forward. Although of course we have to remember that it's an election year, and
yes,
that is something that all investors are carefully monitoring.
If you start on the MPC and you're at the next meeting, would you suggest they keep it at 16.5, lower it some more, or jack it back up?
I think the reason why it's taken that long to actually bring it down is the need to ensure that all the key factors that are, the variables that are under consideration are actually, have the effect they've had. And I think there was therefore the desire to ensure that you don't have what you call like knee-jerk reactions to this kind of movements. So I think the desire would be to have a stable, implementation condition. So I would probably say I'd focus on stability before making any other further rate cuts.
So keep it where it is at least for now, so that we have all that lead time to let it take effect.
Yeah, correct. That is correct.
Excellent. I think that's a good place to leave it. Einstein Kihanda, many thanks for speaking with us. Okay.